All right, let's dive right into this. Welcome to our documentary-style check-in on the GoldMining Loonie US dollar Canadian dollar steady series. In this explainer, we are going to be analyzing algorithmic execution with absolute, unvarnished transparency. Look, we aren't here to just show you cherry-picked highlights or parade around unrealistic gains. Instead, we're documenting the factual, day-to-day reality of a live, automated trading strategy as it navigates the actual, real-world currency markets.
So, as we enter week 30 of this journey, our focus remains exactly where it should be, on disciplined, long-term account progression. Steady progress is absolutely the anchor here. The priority right now, it's not about chasing some rapid, high-risk profit just to make up for lost ground. No, it's about controlled growth, keeping that weekly drawdown low, and frankly, just letting the algorithmic system do exactly what it was programmed to do without any of that messy, manual, emotional interference from us.
Part 1. The long-term journey.
Now, to truly understand where the account stands today in week 30, we have to pull back and look at the overarching reality of this strategy's historical performance, right? Context is literally everything in algorithmic trading. So let's address the historical account drawdown right out of the gate. The current overall growth is sitting at negative 12.04%. And we present this completely honestly because, well, this is the standard unvarnished reality of live algorithmic trading. Every strategy encounters difficult market phases. Hiding a setback? That doesn't help anyone learn. Experiencing a significant equity dip is just part of the documentation process, and accepting it is really the very first step toward a disciplined, systematic recovery. Zooming in on the macro-level metrics, the account currently sits at a balance of $2,170.06. Remember, we're utilizing a cent account for this rigorous testing and documentation phase. Every metric, the initial deposit, the trading activity, the gross profit versus gross loss, is tracked. This level of detail really underscores our commitment to radically transparent documentation. Every single cent and every single trade is completely accounted for. And mapping that exact journey visually, the reality of that previous equity dip becomes crystal clear. You have this distinct peak in growth, which was followed by a sharp drop where the maximum drawdown actually hit 33.13%. So what does this prove? It proves that navigating drawdowns is not a sprint. It is absolutely a marathon, and it requires immense patience. The strategy is operating from this new baseline right now, and it's tasked with slowly, methodically climbing its way back up.
Part 2. Week 30 trading performance.
So let's look at the micro-level data to see exactly how the expert advisor handled recent market conditions. And honestly, we see extreme restraint. The weekly numbers show that the algorithm executed just 2 trades for the entire week. Just 2. That resulted in a very modest, heavily controlled net profit of plus 1.03 cents, which equates to a weekly gain of plus 0.05%. Now, for a strategy that's in a historical drawdown, this level of quiet activity is actually incredibly reassuring.
It is overwhelmingly evident that the expert advisor didn't even attempt any kind of aggressive recovery trading. We all know how it is. When humans are in a drawdown, the psychological temptation is just overwhelming. You want to increase lot sizes, overtrade, and win it all back as quickly as possible. The algorithm, however, it strictly followed its systematic rules. It executed its logic, took a tiny, calculated 0.0475% growth step forward, and most importantly, it kept the maximum drawdown for the entire week to a completely negligible 1.03%.
That stability is incredibly apparent when you review the week's specific performance. The growth trajectory is essentially flat, while the drawdown barely even registers as a blip. It perfectly demonstrates how preserving capital during low volatility periods isn't just a side effect, it's a core, fundamental feature of this system. It waits for the right setups. And if those setups aren't there, it simply doesn't risk the capital. Period.
Part 3. Dissecting the executions.
All right, let's dissect exactly how those 2 specific executions played out in the live market. This is systematic risk management in action. There were 2 distinct buy positions on the US dollar versus Canadian dollar pair. An initial 0.02 lot position was taken, which actually resulted in a negative 23.36 gross loss. However, that was seamlessly offset because the system scaled in to a 0.09 lot position, which generated a positive 23.04 gross profit. Now, when you factor in the positive swap credits of 1.35, the net balance nudges right into the green by that 1.03 cents we discussed a minute ago. This is literally the algorithm mathematically working its way out of a localized grid.
Looking at the market environment the algorithm was operating within, specifically the 15-minute time frame, the price action was highly ranging.
It was a choppy market, just endlessly bouncing between support and resistance without any definitive aggressive trend. But the algorithm navigated that chop with strict, emotionless adherence to its programmed parameters. It closed out the sequence exactly when its programmed net profit threshold was achieved, regardless of how small that profit actually was.
Part 4. Macroeconomic market context. To fully grasp why the trading volume was so incredibly low this week, we have to pull back and look at the larger macroeconomic forces. The currency pair didn't just go quiet by accident, you know? It was heavily influenced by a whole confluence of shifting factors. We had changing expectations around the U.S. Federal Reserve's interest rate path, and that was layered right against the Bank of Canada's own domestic monetary policy outlook. Plus, being a commodity currency, the Canadian dollar was reacting to fluctuating crude oil price movements, all while battling the overarching strength of the US dollar across the board.
So all of those complex environmental factors, they definitely compressed market volatility this week, which led directly to that tight, choppy range we were just talking about. But here is the absolute key takeaway. While macro factors drove the market's behavior, they did not alter the expert advisor's restrained and disciplined approach to risk. The strategy absolutely refused to force trades in a market that wasn't providing its preferred structural setups.
Part 5. The architecture of recovery.
Ultimately, what Week 30 proves is that recovery in automated trading is a structural process. It's built on consistency, not hitting grand slam trades. Preventing the expert advisor from overtrading is not some kind of bug. It is a vital, intentional feature. It's specifically designed to protect equity while the strategy slowly, deliberately works its way back from that historical drawdown. We really have to recalibrate our expectations here, move away from the hype and the desire for rapid profit, and lean into the calm, analytical reality that successful algorithmic recovery is, inherently, a gradual process.
We want to invite you to continue following this transparent, long-term journey. The whole goal of this explainer series is to document every single stage, the profitable peaks, the difficult drawdowns, and yes, these quiet, gradual recoveries. So as we close the books on Week 30, I'll leave you with this. When market volatility completely fades and the urge to overtrade really starts creeping in, do you have the discipline to just step back and let a proven system do its job? Think about that. Thank you so much for following along, and we'll see exactly how this strategy develops in our next check-in.